pursued the policies that he believed would ultimately benefit all Americans. My colleagues and I continue to draw inspiration from his example. Turning to today's meeting, my colleagues and I decided to leave our policy rate unchanged after lowering it a total of 0.75 of a percentage point at the previous 3 meetings. As always, we base our decisions on judgment of how best to achieve the goals Congress has given us: maximum employment and price stability. Our economic outlook remains a favorable one, despite global developments and ongoing risks. With our decisions through the course of the past year, we believe that monetary policy is well positioned to serve the American people by supporting continued economic growth, a strong job market, and inflation near our symmetric 2% goal. The economic expansion is in its 11th year, the longest on record. Household spending has been strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. As has been the case for some time, sluggish growth abroad and trade developments have been weighing on those sectors. Even so, the overall economy has been growing moderately. And with a strong household sector and supportive monetary and financial conditions, we expect moderate growth to continue. As seen from FOMC participants' most recent projections, the median expectation for real GDP growth slows slightly over the next few years, but remains near 2%. The unemployment rate has been near half-century lows for well more than a year, and the pace of job gains remains solid. Participation in the labor force by people in their prime working years, ages 25 through 54, has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low- and middle-income communities tell us that many who have struggled to find work are now finding new opportunities. Employment gains have been broad-based across all racial and ethnic groups and all levels of education. These developments underscore for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. We expect the job market to remain strong. The median of participants' projections for the unemployment rate remains below 4% over the next several years. Inflation continues to run below our symmetric 2% objective. Over the 12 months through October, total PCE inflation was 1.3%, and core inflation, which excludes volatile food and energy prices and is a better indicator of future inflation, was 1.6%. While low and stable inflation is certainly a good thing, inflation that runs persistently below our objective can lead to an unhealthy dynamic in which longer-term inflation expectations drift down, pulling actual inflation even lower. In turn, interest rates would be lower as well and closer to their effective lower bound. As a result, the scope for interest rate reductions to support the economy in a future downturn would be diminished, resulting in worse economic outcomes for American families and businesses. Against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. The median of participants' projection rises to 1.9% next year and 2% in 2021. We're strongly committed to achieving our symmetric 2% inflation goal. Over the course of the past year, our views about the path of interest rates that would best achieve our employment and inflation objectives changed significantly as the economy faced some important challenges from weaker global growth and trade developments. As the year progressed, we adjusted the stance of monetary policy to cushion the economy from these developments and to provide some insurance against the associated risks. In addition, inflation pressures were unexpectedly muted, strengthening the case for a more supportive stance of policy. Rather than modestly increasing the target rate for the federal funds rate this year, as seemed appropriate a year ago, we reduced it by 0.75 of a percentage point. This shift has helped support the economy and has kept the outlook on track. The median of participants' projections for economic growth, the unemployment rate, and inflation are little changed from a year ago, aside from a lower inflation projection for 2019. Of course, that is the function of monetary policy, to adjust interest rates to promote employment and price stability in response to forces acting on the economy. We believe that the current stance of monetary policy will support sustained growth, a strong labor market, and inflation near our symmetric 2% objective. As long as incoming information about the economy remains Broadly consistent with this outlook, the current stance of monetary policy likely will remain appropriate. Looking ahead, we will be monitoring the effects of our recent policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the federal funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. Finally, I wanted to note that we've been purchasing Treasury bills and conducting repurchase operations consistent with the plan we announced in December. These technical operations are aimed at maintaining an ample level of reserves and addressing money market pressures that could adversely affect the implementation of monetary policy. Our operations have gone well so far. Pressures in money markets over recent weeks have been subdued. To address possible pressures in money markets over the year-end, we've been conducting term repo operations spanning year-end. We stand ready to adjust the details of our operations as appropriate to keep the federal funds rate in the target range. Thank you, and I'll be happy to take your questions.
Howard Schneider with Reuters. Sorry about that. So I was struck by the sort of disconnect that exists here between the behavior of unemployment and inflation. You seem to have unemployment penciled in here now for 3 years running more underneath the longer run level, yet inflation never really accelerates. So what are we to make of that?
Well, that's what's happening there is the fact that the relationship between resource utilization or unemployment and inflation has just gotten weaker and weaker over the years. If you go back 50 years, you would have seen that when labor markets were tight and unemployment was low, inflation moved right up. And then as the Fed got control of inflation, the connection got weaker and weaker and weaker to the point where there's still a connection, but it's a very faint one. And what that suggests is that you would need to keep policy somewhat accommodative, and we believe that policy is somewhat accommodative. And we think that that's the appropriate place for a policy to be in order to drive up inflation.
Follow up on that. I mean, it's faint and non-existent, though, it seems to me. So this suggests that really your policy lever, as it exists now, isn't really influencing prices at all. So in that case, what do you do to reach your target?
Yeah, no, I don't think that's right. I mean, the relationship between slack in the economy and inflation is weak, has been weak. The coefficient is something like 0.1, so it's much, much lower than it used to be, but I don't know that it's gone down any more in the last decade. It just is quite faint, but it's still there. I mean, you can see it. If you look at where wages were 3 or 4 years ago, they were running around 2%, and now the whole group of different wage measures that we monitor has moved up to 3 and 3.5%, and that suggests tightening. The same thing is true, but much less true of inflation. The relationship between, in a way, the wage Phillips curve has a higher coefficient than the price Phillips curve does. But we do still see some relationship, and that's what you're seeing in those numbers.
Mr. Chairman, Steve Leisman, CNBC. You've used the analogy to 1998 to describe the rate cuts we just went through. And I'm wondering if we can sort of continue the analogy. Within 7 months of those 98 rate cuts, the Fed took them back and then some. So were those kind of rate cuts the kind that you need to take back? Or are we at a place now where we're at a neutral rate? Take back, I mean, if those risks that you say we're cushioning from don't materialize in the way you think. Or is this now a new sort of steady state for the economy at this rate? This is the right rate for the economy that you see going forward and don't need to take those rate cuts back?
So there's similarities, conceptual similarities, I think, between the two instances during that long expansion, I guess in 95 and 98, when the Fed cut 3 times only to resume raising rates. And the notion just is that the economy needed slightly more accommodative policy, but it wasn't the end of the expansion, right? And that's the same situation we believe we're in here. So we did in fact turn out to do 3 rate cuts. That wasn't in the plan, in any kind of specific way at the beginning. So that's the same. What's different is you have very different structural characteristics in the economy, particularly around inflation. So now as you can see, inflation is barely moving up, notwithstanding that unemployment is at 50-year lows and expected to remain there. So the need for rate increases is less. And by the way, it's a good thing that we think we can. I think we've learned that unemployment can remain at quite low levels for an extended period of time without unwanted upward pressure on inflation. In fact, we need some upward pressure on inflation to get back to 2%. It's quite different in 95 and 98 when there were those two adjustments. So I would say similarities and differences.
BIS concluded in, I did the same thing as Howard. Michael McKee, Bloomberg Radio and Television. The BIS concluded in September that the repo spike was not a one-off confluence of random events, but reflected structural and regulatory issues that could lead to a recurrence. I'd like to ask you if you agree with the BIS findings, and given that we're approaching year-end for the markets, will you be taking any extra steps to ensure that funding is available in the repo and FX swaps markets? There was a report yesterday from Credit Suisse suggesting there's a good chance that we will see disruptions, and one of the reasons they put for it is that the Fed is, at this point, buying only T-bills, and the market wants to sell coupons. Do you have any plans to sell coupons?
So I'm going to take a little step back, and I will get to your specific questions on the year-end and on T-bills. So I guess I want to start by stressing that these are very important operational matters, but that are not likely to have any macroeconomic implications. We decided back in January to remain in an ample reserves regime, and that means we will be setting the federal funds rate, the range for the federal funds rate, through our administered rates and not through active management of the level of reserves. We're committed to robustly implementing that framework, as you can see by our actions. And the purpose of all this, let's remember, is to assure that our monetary policy decisions will be transmitted to the federal funds rate, which in turn affects other short-term rates. We have the tools to accomplish that, and we will use them. The purpose of all this is not to eliminate all volatility, particularly in the repo market. So taking you back, as you know, we very gradually allowed the balance sheet to shrink. We slowed that gradual pace by half in March, and then we ended it in July. Meanwhile, we had surveyed all of the banks, and particularly the large banks who hold a lot of the reserves, and said, what's your lowest comfortable level of reserves? We got those numbers, we added them up, we added a buffer, and it came out sort of at a level that was well below when we were in September. And yet, we saw actually in September that the markets acted as though reserves had become scarce. So what had happened was that liquidity, which actually existed, didn't flow into the repo market, and that had effects on the federal funds rate. So the question is, why did that happen? And we've been very carefully looking at the reasons why that might have happened. There are payments issues. There have been a number of supervisory and regulatory issues raised. We're looking carefully at those. We're open to ideas for modifying supervisory and regulatory practice in ways that don't undermine safety and soundness, and a number of ideas are under examination there. To go through it sort of in time, we started off really on September 17th with overnight operations. By October 11th, we had created and put into effect a plan. That plan is in effect. It's working. I think for the last couple of months, repo markets have been functioning well. Short-term rates are stable. Markets are functioning. So you asked about year-end. Temporary upward pressures on short-term money market rates are not unusual around year-end. And both our repo operations and Treasury bill purchases are intended to mitigate the risks that such pressures pose to our control of the federal funds rate. We think that the pressures appear manageable, and we stand ready to adjust the details of our operations as necessary to keep the federal funds rate in the target range. Our strategy has been essentially the key to our strategy is to supply reserves in the near term through both overnight and term repo, and at the same time we're raising the underlying level of reserves through bill purchases. I'll take that now. We've said bill purchases. We've also said that we were willing to adapt our strategy. We're not at this place, but if it does become appropriate for us to purchase other short-term coupon securities, then we would be prepared to do that if the need arises. So, but we're not in that place. It very much looks like those bill purchases are going well just according to expectations. I mean, the other thing I'll say is that we're in, very regular contact with market participants all the time. We'll be continuing that, and we're prepared to adjust our tactics. We're focused on year end as well, and prepared to adjust our operations as appropriate.
The follow-up to that would be, where are we with the possibility of a standing repo facility?
So on the standing repo facility, as you know, we've actually had a couple of meetings where we've discussed that. I think the standing repo facility is something that'll take some time to evaluate and create the parameters of and put into place. At the moment, what we're focused on is, we're now focused on year end. I should also mention that after year end, the sense of it is that as the underlying level of reserves moves up because of bill purchases, as that happens, there will come a time when it will be appropriate for overnight and term repo to gradually decline. We can't know today what the timing of that will be, but that's the way we see it going over time.
Heather Long from the Washington Post. A number of your colleagues have said explicitly that they do not think the FOMC should raise interest rates until core inflation is back at 2%. They think there should be a rule. Where do you personally stand on that?
Well, as I mentioned actually at the last press conference, we think our policy rate is appropriate and will remain appropriate as long as incoming data are broadly in keeping with our outlook. And in order to move rates up, I would want to see inflation that's persistent and that's significant. A significant move up in inflation that's also persistent before raising rates to address inflation concerns. That's my view.
So is this the de facto policy of the committee then? I guess I'm wondering why it's not sort of codified in a statement.
We haven't tried to turn it into some sort of official forward guidance. It happens to be my view that that's what it would take to want to move interest rates up in order to deal with inflation.
Gina.
Hi, Chair Powell. Gina Smiley with the New York Times. Just following up on Heather's question. So if you look at the SEP today, it looks like inflation is never overshooting 2% and is only getting up to 2% by the end of 2021, yet rates are increasing in 2021. So I guess how do we square that circle with interest rates increasing before inflation ever really moves up in some meaningful overshooting way?
So I think what you're seeing is you've got a full year of the median being flat, which is, we think, accommodative, modestly accommodative, and inflation not moving up very much, as we've discussed. And that underscores, I think, the challenge of getting inflation to move up. The committee has wanted inflation to be at 2%, squarely at 2% ever since I arrived in 2012, and it hasn't happened. And it's because there are disinflationary forces around the world, and they've been stronger than I think people understood them to be. In terms of those out-year rate increases, what you're looking at rate increases more than a year into the future, and people will have their own explanations for where they do that. But none of us have much of a sense of what the economy will be like in 2021. So I think what may be behind some of that is just the thought that over time it would be appropriate, if you believe that the neutral rate is 2.5%, it would be appropriate for your rates to move up in that direction. I will also say to you that a number of people wrote down, and you can't see this at this level of detail, but today, but a number of people did write down overshoots of inflation as appropriate under appropriate policy.
Brendan.
Brendan Greeley from the Financial Times. Given that inflation, whichever measure you choose, has either sort of remained where it is or not increased over the past year as you've been dropping the policy rate, what is it that gives you confidence that the Fed has the tools to get inflation back up to target or even overshoot, as you just indicated that some people are considering doing?
Well, it's just that there is still empirically, by many different, by the work of many different analysts, there is a relationship between resource utilization, by which I mean unemployment, and inflation. It's just relatively weak. And by the way, that's not a bad thing. That means that we can run at low levels of unemployment and have a historically good, in some dimensions, labor market without having to worry about inflation. It also means, though, that it's not easy to move inflation up. Now, you say, why is there confidence? I mean, I would say there's more humility than there is confidence in this at this point. It's been very challenging to get inflation to be at target. If you look around the world, the United States, of all major economies, has been closest to it, but still hasn't quite been able to achieve it. And I would also point out that this year, which has been a good year for the economy, core inflation is actually running at 1.6%, whereas it ran close to 2% most of last year. So it's a real challenge, and but I think we're using our tools as best we can to meet that challenge.
Nick Timmeros, The Wall Street Journal. So, Chair Powell, I want to ask about the framework review, which obviously entails some kind of debate around allowing an overshoot of the 2% target. And in that context, is merely saying that you want inflation to rise above 2% a sufficient strategy for getting inflation to stay at the target, or would it compel some kind of policy action beyond deferring future rate increases to achieve that outcome, if that's the direction in which the committee goes? In other words, it's one thing to accept inflation rising on its own opportunistically, but if inflation does not materialize, would a change in the framework necessarily make it easier to generate higher inflation?
Well, I think the answer to the question of whether saying it is enough to create credibility, the answer to that is no. And I think you have to back that up with policy that supports the outcome. And that's what we're trying to do. And so the changes that we're looking at to the framework are I think they take all of that on board. But what they are designed to do is to strengthen the credibility of that inflation target, but only if followed by policy. Ultimately, it will take time to move inflation expectations up from where they are, which appears to be a bit below 2%, will not happen overnight. It'll have to happen over time as credibility is built. The Fed has great inflation credibility, but inflation expectations are anchored at about their 25-year average, which is a few ticks below 2%.
We talked a lot about inflation. Edward Lawrence from Fox Business Network. We talked a lot about inflation. I want to ask you about uncertainty. With the House announcing that they will ratify USMCA and Canada and Mexico signing off on it, do you see that uncertainty easing now so the business investment could pick up? Or are the trade tensions with China just that big elephant in the room where you might not see those business investments pick up?
Well, I did see the news today that it appears there's an agreement to move forward to a vote on USMCA, and of course it's not our role to comment on particular trade policies or criticize them one way or the other or evaluate them. I will say, though, that getting if the deal were to be enacted, then it would certainly remove some of the trade policy uncertainty, and that would be, I believe, a positive for the economy. And I'll say the same thing about the negotiations with China, which haven't reached that point yet. We've been hearing from our people that we talk to, the many people and businesses that we talk to through the reserve banks that wind up being written up in the Beige Book, and they've been telling us all year, for a year and a half really, that trade policy uncertainty is weighing on the outlook. And I do think that, again, without commenting in any way on the process or the content of the agreement, I think that removal of uncertainty around that would be a positive for the economy as well.
Is one uncertainty bigger than the other? Do you see, not commenting on the deals themselves, is one uncertainty for business?
I think you can, I think you can see that what's been moving. One way to look at it is what's been moving financial markets. It's been news about the negotiations with China, not so much USMCA. I think that the difference between NAFTA and USMCA is smaller than the difference between current, arrangements with China and what's being negotiated.
Hi, Matthew Boesler with Bloomberg. Chair Powell, the Fed policy review this year has largely been discussed in terms of the inflation side of the mandate and the need to shore up inflation expectations. But it seems like the message you've been getting from the Fed Listens events and also something else you've recently acknowledged is that the Fed has also been systematically overestimating labor utilization throughout this expansion. So I'm wondering if you could talk a little bit about the extent to which the review is looking at the employment side of the mandate as well. Are there any possibilities, for perhaps systematizing a more asymmetric reaction function with regard to unemployment? Thank you.
Yeah. So the focus really is on how to use our strategies, tools, and communications to achieve both sides of the mandate. You're right, though, that we've talked here a lot about inflation, and I think that I think more broadly, over a period of years, many years, we've been learning that the natural rate of unemployment is lower. It's in estimates, not just at the Fed, but broadly among economists, labor economists, have seen that the connection that we can sustain much lower levels of unemployment than had been thought. And as I mentioned, that's a good thing, because that means we don't have to worry so much about inflation. And you see the benefits of that in today's labor market. The Fed Listens event are about inflation to a much lesser extent than they are about maximum employment. If you listened to or attended any of those, the discussion, we always focus on inflation as well, but the discussion is really around what's happening in low and moderate income communities and among small businesses. And I think you get a perspective which we were already getting that from our extensive outreach to community groups and such, but it was helpful to get it in the context of a monetary policy review. And I think that the fact that these communities have such high levels of unemployment and low levels of labor force participation tells you that there is slack out there. And I think that does also inform our understanding of what we mean by maximum employment. And it's been a very positive. I would say that the Fed Listens events have been extraordinarily positive, and they're certainly something we'll repeat. You also see from the business perspective that companies are taking all kinds of measures to look through things on people's resume that would have perhaps disqualified them in other kinds of environments. Training is moving up. You hear just a lot. There are a lot of things going on that suggest that people at the margins of the labor force are being pulled in and being given chances, which is a great thing.
Victoria.
Sorry, if I could just follow up briefly. Is there any way to sort of systematize these insights, do you think, in terms of, we talk a lot about, for example, make-up strategies on the inflation side. Is there anything similar you could do on the employment side?
I think we have kind of internalized, and this isn't news for today. This is something we've been saying for several years. You've seen us moving down our estimates of maximum employment. In fact, it's already understood, I think, that there's more. Even though we're at 3.5% unemployment, there's actually more slack out there, in a sense, and the risks of using accommodative monetary policy, our tool, to explore that are relatively low. I think we know that, and I think the review certainly underscores that. But that's a very important insight.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask more about the repo issues and what you all are doing beyond open market operations. Are you currently, for example, telling examiners not to prefer reserves over treasuries for supervisory purposes? Are you talking to the Treasury Department about maybe reducing the level of volatility in their account at the Fed? And on the standing repo facility, is it that you would be inclined to do it, but you need to figure out the details, or what would kind of drive the decision on whether or not to do that?
So on treasuries versus reserves, we've done a ton of work on that. We've talked to supervisors, and it's interesting. If you look at the banks, they're all over the place on the composition of their buffer. So you have a business model, and that business model suggests what your stress outflows will be, and that suggests what your buffer should be. And you see them making quite different choices. Some of them have lots of reserves and fewer treasuries, and then they change their mind and they switch. So it's not obvious that there's one thing happening there. Notwithstanding that, we've gone out to try to understand that, talking to the supervisors. In terms of the TGA, we have not tried to pull the TGA into this yet we've taken it as exogenous. I don't know that at some point we won't have those discussions, but Treasury, we want Treasury to be able to have the cash that it needs, and then we are essentially taking that as exogenous to our work. There may come a time when we talk about that, but we haven't done much of that. Standing repo facility. So your question on that is, what are we thinking about it? What are we? I think we are more focused, frankly, on the bill purchases, the year end, and also the review of supervisory and regulatory issues that we're digging into, and because we think these are structural things, right? Where you could, without sacrificing safety and soundness, just allow the liquidity that is already there to flow more freely, perhaps by making fairly straightforward, non-controversial changes. And we think there is some of that, and so we're working hard and fast. But those are things, if they take rule changes, it'll take, a notice of public rulemaking, it'll take 3 months and things like that. Those things take time. These things that we're working on now, though, like, going through year end with the overnight facilities and the bill purchases and the term repo, those are things that we have to do right now and are doing.
Chris?
Hi, Chris Rugaber at Associated Press. I wanted to ask, the only change in the statement was a drop in the reference to uncertainties around the economy. You seem very confident, or it implies there's a lot of confidence that those uncertainties have gone away. What caused you to make that change for this statement? What were you looking at that seemed to be so much lower?
We did actually, if you look at the statement, you'll notice that we did call out global developments and muted inflation pressures later in the statement. And why did we do that? Those are the things that we've been monitoring all year. We've put now in place policies that we think are appropriate to address those things. So we're not revisiting that. But those are just key things, and they haven't gone away. So we thought it was appropriate to mention them there. Still subject to the idea that for us to change our stance, we would want to see a material reassessment of the outlook.
Well, just to follow real quick, on the material reassessment aspect, are you worried that has set too high a bar for potential cuts next year? We were talking about rate hikes, but no Fed policymaker seems to foresee any cuts next year. Some economists do. Does a material reassessment mean you need to see data actually worsen? Does it reduce your ability to act preemptively the way arguably you did this year?
So, one thing that we're mindful of is that we've cut rates 3 times since July. That's 75 basis points worth of cuts. And we do believe that monetary policy operates with long and variable lags, and that it'll take some time before the full effects of those actions are seen in the economy. So that'll take some time. So that's one reason to hold back and wait. And we think we took strong measures. In fact, if you look at more broadly at the Treasury yield curve, it has moved more than 75 basis points. So you've had quite a significant move in the direction of higher accommodation. In terms of what is material at the end of the day, I would just say whether or not a change in the outlook merits a policy response will be a collective judgment of the FOMC. There isn't any single factor that will determine our decisions. We'll look at a full range of data and other information bearing on the economic outlook.
Okay, Scott Horsley.
Thank you, Mr. Chairman. Scott Horsley from NPR. You started out by talking about Paul Volcker, who obviously cast a long shadow. I wonder if, in hindsight, that shadow was too long, and if in the decades since his tenure, and in particular last year, if the Fed was too quick to raise interest rates to attack an inflation boogeyman that didn't materialize.
This wouldn't be my response will not be about Paul Volcker, but although you started with Paul Volcker. So if you look back at 2018, I'll just take you back to the beginning of 2018. We had an economy growing at 3%, we had inflation at 2%, and we had $1.5 trillion worth of stimulus arriving, and the federal funds rate was 1.4%. So it wasn't that. So we moved policy up during the course of the year. We never got policy even at the level of what we thought the neutral rate was at the time. So there was no sense of it being restrictive. we took steps to make it less accommodative, and that seemed to be the right thing. It still seems to me to be the right thing in hindsight. The idea that we were trying to, slow the economy down, we were really just trying to get near neutral. And even with the last rate increase a year ago, we were still meaningfully below the median estimate on the committee of what the neutral rate was. So policy was always accommodative during the course of that year. I think what's happened is obviously the facts on the ground have changed. You saw the global economic slowdown begin in the middle of last year, gather force, and then continue to go on this year. So you've seen a continual weakening. Just look at the IMF's forecast of growth from the spring of 2018 and compare them to now. You've had quite a significant, that does affect us. I think also the trade situation was just beginning in the middle of 18, and I think it has had, I think there'll be very, very wide range of estimates of the effect, but I think it's had a meaningful effect on output just through the uncertainty channel and to a lesser extent through.
But I will provide a little context.
Okay, so I'm not going to give you.
I want to be clear about the picture. One way to look at the picture, really, and that is this: if you can get at this by looking at the widest measure of unemployment, of labor market slack, if you will, is the U6 measure, and that's the one we talk about all the time is called U3 by economists, and the one that has a much broader measurement of slack in the economy is U6. So in U6, the U6 level of unemployment has tripled from 7% to 21%. That amounts to 22 million additional people who've lost work in the economy, either by going to part-time or something like that. So that's in the low 20s, and that's post the May employment report. You can get at it a different way. You can look at just the regular unemployment rate. You can take the 21 people who are listed as unemployment now. You can add more on for the ones who are miscoded. You can also take those people who are suddenly out of the labor force. You put those together, and that has gone up by about 24 million. So those are two different measures of what's happened. So the question is 22, 24 million people. Got to get them back to work. Somehow we got to all, as a country, get those people back to work. They didn't do anything wrong. This was a natural disaster. And I do think the responses so far have been great. So that's the way I would think about it. And if you think, I would just, in terms of the May employment report, it's so nice to see. I mean, I think what people were thinking was that you'd start to get those back to work kind of numbers in June and July and August. Very few people saw them in May. I mean, almost no one saw that happening as early as mid-May, but it did. And so, and we don't know fully what that means, whether it's just a timing change or whether it will prove to be much more than that. We're going to have to wait and see. It is, as I mentioned earlier, it is clear evidence of just how uncertain things are and how humble we have to be about our ability to really have confident predictions as opposed to just predictions. So bottom line, I would just say that is the key thing people need to understand is that there's just a lot of work to do in the labor market. We're going to stick with this and support that until the work is done. That is something we're going to do with all of our tools. And I think it may require Congress to help as well. It may, but that's going to be their decision. You also asked about the second wave. Yeah, so we have major responsibilities and powerful tools, but the decision about when to reopen the economy is one for elected officials at the state and local and federal level. And if they ask, we don't have any particular expertise here at the Fed in pandemics or coronaviruses or anything like that. We talk to experts, but so we don't have anything special to add on that. I would just say it's kind of self-evident, I think, that if it happens, the issue would be, first of all, people's health, but secondly, you could see a public loss of confidence in parts of the economy that will be already slow to recover. So it could hurt the recovery, even if you don't have a national level pandemic. Just a series of local ones, of local spikes could have the effect of undermining people's confidence in traveling, in restaurants, in entertainment, anything that involves getting to people together in small groups and feeding them or flying them around. Those things could be hurt. So it would not be a positive development, and I'll just leave it at that.
Thank you. Thank you. Edward Lawrence.
Thank you, Chairman Powell, for the question. On the Wall Street lending facility, in May we saw at least 55 companies file for bankruptcy. Do you think that it is too late? First of all. Second of all, the future of these facilities, is this a one-year impact to the economy through these facilities, or is this a multiple year? If so, how many years?
We have, significant interest, we think. And also remember, lots and lots of companies are getting financed, too. The banks are lending, the markets are open. You have a much better lending climate than certainly than we had in February and March. We don't think it's too late, though. We do expect it to be up quite soon. In terms of the timing of these things, so we'll leave them open for new loans as long as they need to. That'll be a decision we make, of course, with our colleagues at the Treasury Department. And at a certain point, there won't be a need for further loans, and then the assets will be there. And so if that's, I don't know if that's part of your question too, but I would just say that at that point, the useful role of the Federal Reserve is probably close to an end at that point. We don't have any expertise in managing pools of credit assets, loans, if you will, or bonds. And we don't want to be we don't really want to be part of the decisions that have to be made to manage such a portfolio. So we'd be looking to have that done either someplace else or by a third party or at the Treasury Department or something. And we're working on ideas for that. But our real focus now is getting these facilities going and getting them to do the job that they need to do.
Thank you. Jonelle with Reuters.
Thank you, Chair. So I have two quick questions. One is if we have hit bottom for the economy, and the second question is regarding the way that the pandemic has exacerbated racial inequality. I wanted to ask, to what extent do you think you can factor in those disparities when you're thinking about maximum employment?
I would say that many forecasters had been expecting a bottom for the economy around the middle of the year with a huge range of uncertainty. I think the labor market, the evidence of one jobs report is that the labor market may have hit bottom in May. We don't know that. We're going to see. And many forecasters widely expect a recovery over the second half of the year. So it is possible, but the thing is, we're not going to overreact to a single data point. We're going to be very careful about reaching any conclusions about good data or bad data. So I think we're going to be here with our tools supporting this economy for as long as it's needed. So, but I think there's a possibility that the bottom has come in the labor market, but we don't know that yet. We'll know more as we go forward. So, in terms of the effect of the pandemic on inequality, what you see, the pandemic, of course, hits everybody, but in an economic sense, it hits those industries that involve groups of people in tight groups, either in places where it's the travel, leisure, restaurant, bars, those kinds of service economy jobs. And so a lot of the lost jobs were from people who work in the service economy dealing with the public, for example, and relatively, compared to other jobs, relatively low wages. So if you just look at what that is, unemployment has gone up more for Hispanics, more for African Americans, and women have borne an extraordinary, a notable share of the burden beyond their percentage in the workforce. So that's really really unfortunate, because if you just go back 2 months, where we had effectively the first tight labor market in a quarter century, and for the last couple of years before the pandemic hit, you were seeing wages go up the most for people at the lower end of the wage spectrum, and that was great. And we were meeting with people from low and moderate income communities all over the country and hearing, don't change this. Do whatever you can. Keep this going. This is the best labor market we've seen. And we had every expectation, every reason to expect that this would continue. And then this comes. So it's heartbreaking. And, we want to get it back. So we really want to get it back. And so I think we learned a number of things over the course of the last few years. One of them is that, you can have 3.5% unemployment for a couple of years, and really you see modest moves in wages and relatively almost invisible moves in inflation. So that was not anybody's understanding of the structure of the economy, I think, or most people's anyway. So we can use our tools to support the labor market and support the economy. We can use them until we do fully recover, and that's what we're planning to do. We don't target different groups, but we are cognizant of the fact, though, that late in the last cycle, late in the last expansion, the benefits really do go more to people at the lower end of the wage spectrum for the first time in many years, when labor markets are tight, when unemployment is low. And so we would really like to get back to that place.
Victoria, Politico.
Hi, Victoria Guido with Politico. I just wanted to follow up on a couple of things that have already been asked. First of all, on fiscal policy, you all obviously put out your summary of economic projections today, and I'm curious to what extent future fiscal policy is factored in or not factored in to those projections, and how more or less fiscal policy might affect those projections. And then my other question is on Main Street. You've mentioned multiple times that the Fed and Treasury are willing to expand the program further. So my question is, what's the threshold for those types of changes? Is it just making sure that borrowers that want to borrow through the program are able to do that?
In terms of the way we do forecasts is we don't tend to incorporate things we're highly uncertain about. So I think the forecast would not have included substantial additional, big additional fiscal support for the economy. Maybe a modest amount, something that looks like a low-end guess on what might come out of the current negotiations. That's basically what would be in the baseline. So of course, if there were more fiscal support, you'd see better results sooner. But that's a question for Congress. We're spending a lot, and that's really what they get to decide. In terms of Main Street and our willingness to expand it further, I think one thing we're looking at, very strongly looking at, is nonprofits, and is there a way to incorporate them into that facility or a similar facility? So that's another dimension. If we had a great idea for changing Main Street, we would have done it, and we have done some things that I think are really very positive lately here. But as we learn more, it could be in terms of size, it could be in terms of lots of different things. But I think we have a good product to go to market with now, and I think it'll get out there soon, and we'll see, and we'll be willing to continue to adapt.
Thank you, Don. Thank you, Don Lee.
Hi, as you know, the vast majority of people who have been laid off are expecting to be recalled by their employers. At this point, what is your expectation of how much of these job losses will be permanent?
Reliable estimate of that. Clearly, not everyone will go back, but I would say many will go back. But what's going to be the remainder when when we reach sort of what is the new normal? It's so uncertain, but it could be a good number of millions of people, I think, in many estimates. But I'd say you're so early in the process. For example, people are going back and looking at other significant changes in the economy, and they've seen how many people go back when, for example, there's technological change and things like that. You may have seen some of this research, and you come up with an estimate. It's just going to be very hard to say. But my assumption is that there will be a significant chunk well into the millions. I don't want to give you a number because it's going to be a guess, but well into the millions of people who don't get to go back to their old job, and in fact, there may not be a job in that industry for them for some time. There will eventually be, but it could be some years before we get back to those people finding jobs. I mean, when people lose a job, if they can find a job in their own industry, that's usually the fastest way, is they know other people in that industry, different kinds of jobs. That's usually the fastest. If you have to go to a different industry and start over again, it's much harder, and that's where you start to lose people who are just fall out of the labor force, and you know, it's very tough on their lives. We all know people to whom that happened in the global financial crisis, and hence our desire to do what we can to support this and support this recovery with the tools that we have.
Thank you, Nancy Marshall-Genzer.
Marketplace. Chair Powell, I'm wondering, I want to go back to the issue of inequality, and I'm wondering what more could the Fed do to reduce economic inequality in this country? I mean, I know that you said you don't target certain groups, but is there a way you could use, for example, the Black unemployment rate as some kind of a benchmark to something you want to meet or something that you track of?
We do track all unemployment by all kinds, as you know. All kinds of different demographics, including particularly the African-American unemployment rate, which reached an all-time low since the data started being kept in the modern era. Of course, it's still close to twice the white unemployment. It is twice the unemployment rate, or it was back then. It's certainly much higher now. You know, the best thing we can do with our monetary policy tools is to look at you know, the evidence of what we saw with our own eyes so recently, which is that the economy can have very low unemployment, very low unemployment. It could have been lower than we were. It could be lower than 3.5% without seeing financial imbalances, without seeing inflation getting out of control. We frankly didn't even get inflation back up to target, without seeing wages getting out of touch with where they should be. So that's the biggest thing we can do. You know, inequality is something that's been with us increasingly for more than 4 decades, and it's not really related to monetary policy. It's more related to, there are a lot of theories on what causes it, but it's been something that's more or less been going up consistently for more than 4 decades, and there are a lot of different theories. One of which just is that globalization and technology call for rising levels of skills and aptitudes in education. And the U.S. educational attainment kind of flattened out, certainly relative to our peers, flattened out over that period. And so that means if you're on the right side of those trends, then those things are good for you. If you're not, then your wages are going to stagnate. And wages for the bottom, 10% really haven't gone up in real terms in a very long time, and over a long period of time. Whereas wages for the people at the top, compensation, any way you cut it, before taxes, after transfers, all of those, any way you cut it, compensation has gone up a whole lot for people at the top, and it really hasn't gone up for people at the bottom. If you look more in the middle, then it has gone up for most other groups, but at the bottom, not so much in real terms, in inflation-adjusted terms. So, we call it out as an important factor in the economy, and we will use our tools to support maximum employment and take that, definition to heart. But obviously, that's something that's going to require an all of society, all of government response.
Thank you. For the last question, we'll go to Michael McKee. Thank you. For the last question, we'll go to Michael McKee with Bloomberg TV.
Mr. Chairman, Michael McKee, Bloomberg Television and Radio. I came across a statistic the other day that amazed me. Since your March 23rd emergency announcement, every single stock in the S&P 500 has delivered a positive return. And I'm wondering, given the levels of the market right now, whether you or your colleagues feel there is a possible bubble blowing that could pop and set back the recovery significantly, or that we might see capital misallocation that will leave us worse off when this is over. And second,
inequality is not just about wages, it's also about wealth. And a number of studies have suggested that by keeping rates low for so long and targeting the markets after the great financial crisis, that the Fed did contribute to wealth inequality in this country. And I'm wondering if you think there is some tweak or some message you could give that would affect that.
What we've targeted is broader financial conditions. If you go back to the end of February and early March, you had basically the world markets realized at just about the same time, I remember that Monday, that there was going to be a global pandemic and that this possibility that it would be contained in one province in China for all practical purposes was not going to happen. It was, it was Iran, Italy, Korea, and then it became clear in markets from that point forward, investors everywhere in the world for a period of weeks wanted to sell everything that wasn't cash or a short-term treasury instrument. They didn't want it to have anything that had any risk at all. And so what happened is markets stopped working. They stopped working, and companies couldn't borrow. They couldn't roll over their debt. People couldn't borrow. So that's the kind of situation that can be very financial turbulence and malfunction. A financial system that's not working can greatly amplify the negative effects of what was clearly going to be a major economic shock. So what our tools were put to work to do was to restore the markets to function. And I think, some of that has really happened, as I mentioned in my opening remarks, and that's a good thing. So we're not looking to achieve a particular level of any asset price. What we want is investors to be pricing in risk like markets are supposed to do. Borrowers are borrowing, lenders are lending. We want the markets to be working. And we're not looking to a particular level. I think our principal focus, though, is on the state of the economy and on the labor market and on inflation. Now, inflation, of course, is low, and we think it's very likely to remain low for some time below our target. So really, it's about getting the labor market back and getting it in shape. That's been our major focus. And I would say, if we were to hold back, because we would never do this, but the idea that just the concept that we would hold back because we think asset prices are too high, others may not think so, but we just decided that that's the case, what would happen to those people? What would happen to the people that we're actually legally supposed to be serving? We're supposed to be pursuing maximum employment and stable prices, and that's what we're pursuing. We're also pursuing financial stability, but there you have a banking system that is so much better capitalized, so much stronger, better aware of its risks, better at managing its risks, more highly liquid. You have all of those things, and they've been lending, they've been taking in deposits, they've been a source of strength in this situation. So I would say that we're tightly focused on our real economy goals, and again, we're not focused on moving asset prices in a particular direction at all. It's just we want markets to be working, and I think partly as a result of what we've done, they are working, and we hope that continues. Thank you very much.
Thank you.